Okay, let's dive in. Today we're unpacking some really key documents. These are the first big public financial results from Canara HSBC Life Insurance Company Limited for the half year ending September 30th, 2025, H1 FY26. And these aren't just, your standard earnings release. This report card comes right after a massive milestone for them.
That's absolutely right. Yeah, this deep dive is pretty unique because, look, these are the very first results they've put out since the company went public. The IPO was just weeks before October 17th, 2025. So the goal isn't just looking at profit in isolation. It's really about seeing if their traditional strengths are holding up. Their huge bank assurance footprint. How's that performing under the glare of public scrutiny? And how are they balancing that core with, well, new strategies and growth?
Right. So our mission here is to get the ultimate shortcut from these results. We need to distill these numbers, everything from, say, premium growth to those profitability margins, and really try to understand the operational strategy behind the performance. Are they beating their peers? And maybe more importantly, why? Okay, let's kick off at the top line. The growth story here, it jumps out straight away. Their total premium income grew by, what was it, a really robust 24.9% year on year, which hit over 4,000 crore for the half year, 4,042.1 crore to be exact. But, for life insurers, the metric people often focus on is individual weighted premium income.
Precisely. Individual WPI. It's essentially a normalized measure, kind of levels the playing field for new business reflecting risk. That grew by 13.8% year on year, reached about 975.2 crore. But the really fascinating part here is the context you need to put around those numbers. It tells a story.
Okay, give me that context then. How does that 13.8% stack up against everyone else?
Well, significantly better. They're seriously outperforming the whole sector. In that same time frame, H1 FY26, the overall private insurance players, they collectively grew only about 8%. And the entire industry, even including the huge public sector guys like LIC, only managed about 2% growth. So
Yeah.
Canara HSBC Life is growing, multiple times faster than the industry average. That suggests some really disciplined, targeted execution going on.
Wow, okay. That immediately puts them in a different league. But hang on, rapid growth can sometimes be a bit misleading, right? If you're just writing business that lapses quickly, that doesn't stick around. How healthy is the existing policy base, the back book?
Yeah, good question. And that's where the renewal premium growth becomes so crucial. It's excellent news here. Renewal premium grew by a massive 28.8% year on year, reaching 2,333.5 crore. That's a substantial jump. It indicates really robust health in their existing policy base, and it's directly backed up by improving persistency ratios.
Okay, I want to pause on those persistency ratios for a second because they really prove the quality, don't they?
Absolutely. They're key. The 13th month persistency, so the policy's still active after year one, that improved to 84.4%. And if you look out further, the 61st month persistency, so 5 years out, hit 58.4%. Seeing improvements across these key cohorts, it proves they're not just selling more policies, they're actually selling better quality business. And they're retaining those customers efficiently. That feeds directly into long-term profitability, which is what you want to see.
And with all this premium flowing in, are their assets under management keeping pace? Or are they maybe struggling to deploy those funds effectively?
No, they seem to be keeping pace quite well. Their total AUM, assets under management, it grew, hit 44,089.8 crore. That's an 11.3% increase year on year, which is solid growth.
Yeah.
Seems pretty consistent with their top line expansion.
Okay, let's pivot a bit now. Moving from just sales volume to the real bottom line, profitability. In the insurance world, the key measure everyone watches for future health is the value of new business, or VNB. What did these results tell us about how profitable this new business actually is?
Right, the VNB. It basically estimates the present value of future profits from the policies they sold in this period. Their VNB stood at 214.3 crore. That's strong growth, 20.6% year on year. And maybe even more importantly, the VNB margin. The expected profit percentage on each policy sold improved significantly. It reached 19.6%. That's up from 18.1% in the same period last year, H1 FY25.
Wow, hold on. That's a 150 basis point gain in margin. In just 6 months. That's huge. Usually that means they either found a cheaper way to sell or they're shifting the kinds of products they're focusing on. What was the trick here?
Well, it seems to be a strategic focus on product bundling. The margin expansion came from a mix of things. Rising sales volumes, yes, but specifically the increased attachment rate of riders on new policies. Riders, the add-ons like accidental death benefits, waiver premium, things like that. They enhance the core protection. Management seems to have deliberately pushed these higher margin features. It looks like a strategic shift towards, let's say, high-value sales, not just high volume.
And if you connect this to the bigger picture, profitability is also about efficiency, right? keeping costs down. What did the expense side look like?
Their operational efficiency, yeah, it improved quite drastically, actually. The total expense ratio, which measures the cost of acquiring and managing all that premium, it improved. Went down from 20.5% in H1 FY25 to 19.0% in this period, H1 FY26. A 1.5% reduction in that operational expenditure, the OPEX. That's a powerful lever for protecting margins,
Yeah.
especially when, as I think we're about to discuss, the whole sector got hit by some external shocks.
Exactly. And just to wrap up profitability, their long-term measure of shareholder wealth, the embedded value, or EV.
Ah, yes, the EV reached a 6,543.5 crore. And with a very healthy operating return on embedded value, the ROV sitting at 17.4%. That's on a rolling 12-month basis, so looking good there, too.
Okay, here's where it gets really interesting, I think. Everything we've talked about so far sounds pretty glowing, right? Growth, margins, efficiency. But during this exact period, the entire Indian insurance sector got smacked by a major short-term operational headwind. Changes in the goods and service tax regime, specifically the withdrawal of input tax credit, which is basically a government policy change that just made running the business more expensive overnight.
It did indeed hit hard, yeah. To simplify that GST change, input tax credit basically allowed companies to deduct certain costs, like outsourced services, from their total GST liability. Withdrawing that, it means costs they used to subtract now hit their operating expenses directly. Bam. It forced everyone, pretty much immediately, to review their cost structures. And Canara HSBC Life, they were quite explicit in quantifying the damage in their reports.
So what was the immediate hit? How much did it shave off their VNB margin?
Okay, the short-term impact was 50 basis points during H1 FY26, just in those 6 months. But maybe more concerningly, they estimated the full-year impact, if management did absolutely nothing to counter it, was projected to be around 2.25%. Which, would pretty much wipe out all those nice profitability gains we just discussed.
Right. So they couldn't just sit there and absorb that kind of shock. They had to fight back somehow. What was their strategic countermove? What did management say they'd do?
They immediately outlined 3 key mitigation levers. These were specifically designed to protect their margins. The goal was explicit. Aim to keep margins near the FY25 levels despite this external headwind.
Okay, let's break those down. Lever number 1.
First, OPEX rationalization. They're actively building on that already improved expense ratio we saw, the 19.0%. They're basically hunting for further operating expense savings, trying to maintain that low-cost base, digging deeper into the internal operating model, it sounds like.
Okay, level 2.
Second, a deliberate product mix shift. This means consciously optimizing sales towards products with higher margins. And we actually saw some evidence of this already in the results, didn't we? Their credit life portfolio, which sits within group protection, grew over 40% year-on-year. Now, that's typically a high-volume, highly profitable segment, often tied to bank loans. So focusing there makes sense.
Makes sense. And the third lever involves their partners, is that right?
Yes, that's commission rationalization. They're assessing and potentially adjusting commission rates. It seems they're particularly focusing on the renewal business commissions. Now, what gives them maybe a bit of an edge here, a competitive advantage, is that the report noted the commissions paid to their main bank partners are already lower than the industry average, which means they might have a bit more room, a built-in buffer compared to peers when they make these adjustments.
Interesting. So the real story here isn't just the GST hit itself, but maybe the management's swift, comprehensive response. It almost served as a catalyst, didn't it? Forcing a deep operational review focused on tightening efficiency even further. That feels like the mark of, well, disciplined execution.
Okay, let's shift gears to distribution. We know Canara HSBC Life Insurance relies heavily, overwhelmingly maybe, on bank assurance, selling through their powerful bank partners. The Canara Bank channel alone counts for what, about 70% of new business? Wait a minute, though. Isn't that level of reliance on just one main bank assurance partner potentially like a catastrophic single point of failure? How do they mitigate that risk?
That is the critical challenge they face, absolutely. And it's precisely why their strategic diversification efforts are so closely watched by analysts and investors. Now, while Canara Bank is the undisputed cornerstone, they do get another, say, 14% to 15% from HSBC. However, you're right. They know they must diversify further. But, and this is key, they seem to be doing it with extreme prudence. Cautiously.
Okay, tell me about that prudence. How are they being cautious? Well, they've recently launched a new agency channel, building their own agent force, but they're implementing it in what they call a phase manner ramp-up, slowly. Management specifically said they're focused on avoiding VNB compression, because historically, if you aggressively expand a high-cost distribution model like agency too quickly, it can just crush your margins. So they seem to be avoiding this by using existing bank branch infrastructure to support the agency build-out, starting with just 104 branches initially, and focusing that new agency channel exclusively on selling high-margin products. It looks like diversification, yes, but without sacrificing profitability. That's the tightrope walk.
That cautious approach makes a lot of sense strategically. What about digital? That has to be a key part of keeping that expense ratio low, surely.
Oh, digital is a massive strength for them. And yeah, a core reason for their efficiency gains. They reported something like 99% plus of their business is digitally onboarded now, straight through processing.
Oh.
And roughly 85% of customer service requests are handled via DIY, do-it-yourself digital journeys, online portals, apps, etc. That level of automation is pretty much indispensable for managing that improving expense ratio we talked about.
Got it. Now let's quickly look at the product mix itself, often measured by APE, annualized premium equivalent, another standard metric for new business sales. Are customers shifting preferences, moving away from market-linked products maybe?
The mix looks relatively balanced, actually. Unit-linked insurance plans, ULPs, they remain pretty steady at about 50.2%, which means traditional business non-linked savings protection makes up the remaining 49.8%. However, there's a very deliberate and growing focus in the annuity segment. That now constitutes 15.8% of their APE mix, growing share.
Right, annuities. Essential for long-term growth, especially in India's retirement space. But they're tricky, aren't they? The company's making long-term guarantees, sometimes decades out. What happens if interest rates suddenly crash 5 years from now? Are they protected? How do they actually ensure those long-term promises they're making?
That is the absolute essential risk management question when it comes to annuities. You're guaranteeing income streams far into the future. So yeah, you need large reserves held for decades. Now, their current portfolio is mostly comprised of deferred annuities, meaning the payouts don't actually start for, on average, 4 to 5 years. That gives them some time to invest the premiums. But to manage the long-term interest rate risk, they employ a robust hedging strategy. They specifically mentioned using derivatives.
Derivatives. Okay, explain that simply. What does that mean in this context?
Think of it like buying insurance for their profitability on those long-term promises. They're using financial instruments, basically complex contracts, designed so that if interest rates move adversely, say they fall sharply, producing returns on their bond investments, those derivative contracts increase in value, offsetting the loss. It smooths out the risk. They stated they currently have 70% of their non-participating book, which is where these fixed guaranteed annuity products sit hedged, and crucially, they intend to increase that hedging percentage further. It shows they're taking a long-term view, supported by sophisticated risk management tools. Hashtag outro. So to wrap it all up, Canara HSBC Life Insurance is showing some really strong growth figures here, significantly outperforming the broader insurance sector in India right now. And the success seems underpinned by, well, a few key things. Solid operational efficiency, those consistently improving persistency ratios we discussed, and maybe critically a clear defensive strategy. A strategy to manage external shocks, like that GST change, through calculated internal adjustments, cost-cutting, product mix shifts, rather than just taking the hit to their margins.
So what does this all mean for you listening to this? Maybe consider the sheer scale of the opportunity here. The Indian pension market as a whole remains vastly underpenetrated, currently sitting at just, 3% of GDP? Tiny. Now, given that this company seems to have strategically positioned itself with a growing, carefully hedged annuity portfolio, plus that strong bank insurance base and high digital adoption, how significant could the potential be for life insurers like them to really dominate the retirement savings segment over the next decade in India? And maybe think about this. What competitive advantages might they unlock by being an early mover in truly modernizing the pension business in such a massive, untapped market? Something to mull over.